How much should you pay for Colgate-Palmolive stock? Hello fellow investors, I'm screening CL stock at a closing price of 80.38. I think we all know what CL stock is all about. They are widely known for their household, healthcare, and personal care products. This is CL stock valuation summary, all red implying overvaluation. Trading at 13.82 times EPS multiple, 2.3 times their margins, and historically expensive. Price of free cash flow, trailing 12 months is high at 26.61. And PB ratio, MRQ, most recent quarter is very high at 92.51. The stock is simply overvalued, trading at a premium. I don't own the stock. I don't think you should pay premium for the stock. I have a sell rating for the stock. I have a fair value of $30.9. Guru focuses intrinsic value for CL stock is $30.63. So around my fair price. Here are my entry PEs and prices. 10, 12, 14. I have a high price of 33.74. If you're new to the channel, I'll discuss these numbers to you. CL stock is currently trading at $80.38, has a market cap of $67.35 billion, and PE ratio of 33.3. CL stock pays an annual dividend of $1.88 per share, a yield of 2.34% of the current price. The stock is now 7% of the highs. First metric, we want an EPS multiple lower than 3. It's 13.82. It means we're paying this much multiple if we decide to buy CL stock at the current price, with their current earnings of 2.421. To me, it's too expensive. And if you look at the EPS history here, it's always been this low, playing around just 2 to 3 EPS. It increased though, 0.13 EPS in 5 years. That must be because of their share buyback, 37 million shares in 5 years. Second metric, we want to pay $1 or less for 1% of their margins, meaning we want to pay 1 PE or less for 1% of their margins. This is based on the lowest net income or free cash flow margins of these 4 highlighted time frames here. I used 14.48 here as the lowest margin to base my assumptions for my fair values. And I discounted 30%, my normal margin of safety, from the highest margin of 16.27, the 10-year free cash flow margins. This is how I got my entry PEs of 10, 12, and 14. I don't recommend buying CL stock at a premium because look at this revenue growth here. Single digit growth, not worth a premium. At the current PE of 33.3, you're paying a premium of 2.3 times their margins if you agreed to buy CL stock at these prices. Third metric, price to free cash flow is too high. I only have an allowable of 20, therefore I won't be buying the stock based on this metric. Fourth metric shows why they only managed to buy back just 37 million shares in 5 years. Because they give out most of their free cash flow as dividends. 78% payout ratio. We want this below 60. Fifth metric, we want to buy stocks at a lower historical parameter, either PE, price of free cash flow, or PB. Historical PE says it's been trading at 20s of PEs. I don't think it should trade at those levels. I think for CL stock, it should be trading at teens of PEs. Price of free cash flow, I have an allowable of 20. Same with historical PB, I have an allowable of 5. But look at that historical PBs. 40s, 80s of PBs. That's how I know that this stock is just that overvalued. They're not growing as much for these PBs to quickly catch up. It's trading like an Apple stock without the growth of an Apple stock. Again, this is CL stock valuation summary. Everything's connected. Let's confirm our entry prices with their charts. On the monthly, it looks like a Tesla stock. Barely a pullback since the 08. Anyway, 3% yield is $62.67. 4% dividend yield is $47. 5% dividend yield is $37.6. My fair value of the stock is $34.9. This is easily in my avoid list. I refuse to be a bag holder of this stock. That's the huge risk of this stock. It could very well outperform the markets, give you the best returns for your money, but if you're ever putting money on this stock, be known that it should only be for trade and not necessarily a long-term play. That's my take on sales stock, $35 for the long-term entry.